So this presentation is going to be on Introduction to Financial Accounting, and we'll begin by talking about accounting in the business environment. So we'll start with some simple accounting terms that you need to know and build upon. So the first thing we'll talk about is accounting. Accounting is the language of business that measures business activities, processes data into reports, and communicates those results to decision makers. Financial statements are reports on a business in monetary terms. So these are probably all terms that you're familiar with, but now you have a more solidified definition of what these terms mean. There are 4 financial statements. The first statement that you need to prepare is an income statement. The income statement will show us what our revenues and our expenses are, and then from those two numbers we'll be able to calculate what's called net income. The second statement that we'll be preparing will be the statement of retained earnings. This statement simply shows us what the change in our retained earnings are for a period of time. So how did we go from our beginning retained earnings to our ending retained earnings? The third financial statement is the balance sheet. The balance sheet shows us our financial position as of a specific day in time. And the fourth financial statement is the statement of cash flows. And there are 3 sections of this statement that we need to be familiar with, and we'll be looking at those later. There are 2 types of accounting. The first type is financial accounting. In this area of accounting, we produce those financial statements or those reports that provide information to users outside of the company to assist them in decision making. For example, an investor needs to know your financial information to be able to make an informed decision as to whether they want to invest in your company or not. The second form of accounting is managerial or management accounting. This type of accounting information provides information to users inside the company to assist in decision making. So now we'll talk about users of these specific types of accounting information. The first one, financial accounting information, users of this type would be creditors. People lending you money or a company money. They would need to know how financially secure are you for me to be able to lend you money. The second would be investors, which we mentioned before. An investor would want to know, should I invest in this company? Am I going to get a good return? Are they financially stable? A third user would be the government. For example, the IRS. Users of managerial or management accounting would be management. They would take this managerial accounting information and make decisions for the future of the business. Where do we go from here? So just to give us a diagram of what we've just talked about in making decisions, insiders, users of managerial accounting, make decisions for a company. Where are we going to go from here? Outsiders that use financial accounting information will make decisions about a company. So what should I do in regards to this particular company? A few more concepts and principles that we need to have a firm foundation with is GAAP. GAAP stands for Generally Accepted Accounting Principles. And GAAP tells us that information must be 3 things. Useful information must be relevant, it must be reliable, and it must be comparable. So the information that we're given as investors, for example, the information needs to be relevant. Is it relevant for me to be able to make a decision? Is it reliable information? And again, we'll be talking about these in more detail, but reliable. How reliable is the information? Do you have a document stating this is what you paid for this item, or is it just a number you made up? And is your information comparable? So we're given these methods of, for example, inventory valuation methods that we're allowed to use. That way, an investor can look at two companies that are keeping their financial records and say, okay, I know they're following a certain set of rules, therefore these companies are comparable. I can compare them. Without a set of rules, then there's nothing to compare a company with. It's apples and oranges as opposed to apples and apples. So let's look at some examples of these concepts and principles. So Jane's personal assets are not recorded on the company's balance sheet. This is an example of the entity concept. This means that a company is separate from its owner. So Jane is the owner of this company, and her personal assets are not recorded on the books of the company because they are separate entities. Greg records furniture at its cost of $12,000, not its market value of $16,000. This is an example of the cost principle, which states we record assets at what we pay for them. It's historical cost. That is reliable information. Jerry does not make adjustments for inflation. This is called the stable monetary unit. As accountants, we're conservative people, and we do not make adjustments for inflation because we believe over time that the dollar will remain stable. An account payable of $5,000 is documented by a statement from the furniture company showing the business still owes $5,000 on the furniture. Your friend thinks you should only owe about $4,000 at this point. The account payable is recorded at $5,000. That's the reliable amount. This is because of the reliability principle. So you'll note that the cost principle and the reliability principle are very closely related here.